Can buying the dip actually boost your returns, or is it just another investing cliche? In today's video, we are going to talk about buying the dip, and we're going to put some numbers to it. We're going to look at 40 years worth of data and discuss if you would have invested and bought the dip versus if you would have invested and maybe sold during the dip. How would that have impacted your portfolio? Now, it's pretty relevant today. We're at the end of March, beginning of April, and the market has had a dip. And many investors look and they say, what should I be doing here? Is this cause for panic? Do I buy more? Do I sit tight? And there are plenty of options. And in today's video, let's just look at the numbers and see what they tell us. Okay, so this chart here looks at the last 45 years and says if you would have started with $10,000 back in 1980, what would that have done and grown to today, given if you had bought the dip and purchased $2,000 every time the market dropped 8% or more in a month. So these are pretty big dips, dropping 8% in a month, right? And then we have another line that's going to be, what if during that time period you did the opposite and you sold the dip and you sold $2,000 of your investments and purchased 30-day T-bills every time the market dropped 8% in a month. And then we have another line which is going to be, what if you would have just bought and sold? So let's run all these lines out and see where we land. And so the first line is if you would have sold every time the market would have dropped 8% in a month and you sold $2,000 worth of your investments, you would have ended up going from $10,000 to $769,000, which is pretty good growth over an extended period of time. Well, what if you wouldn't have done anything? If you would have just ignored it, never logged in, and let your money continue to grow, your $10,000 would have grown to $1.7 million. So that is more than double. So here's the good news. You didn't have to watch the news. You didn't have to pay attention and figure out when you should sell and move to safety or anything like that, and you ended up with twice the money. Well, what if you would have bought the dip? So when the market dropped 8% in a month, you would have added $2,000 each time. What would happen to your money? Well, instead of being at $1.7 million, you would have grown to over $2.6 million just by adding that $2,000 every time the market drops. And so, okay, great information. If we would have sold, we wouldn't have done great. If we would have bought and hold and we would have bought a dip, we would have ended up with more money. What does that mean for us today? Well, when I look at this chart, I think, okay, it's not necessarily a lesson on what to do because buying the dip can be tricky. How much do I want to buy? When do I want to buy? That means you have to be paying attention in order to buy. And so while it can be a strategy that makes you end up with more money, potentially, it can be more stressful. It might mean you're adding risk that you might not want to do for your portfolio. But what I really take away from this chart is not what to do, but it's potentially what not to do. And more than anything, when the market drops, what these numbers have shown us is that it does not pay to sell into the down market. So when the market has these drops, and it drops all the time, in particular 8-10% is very normal, buying the dip can be great. Holding, also great. But selling after the market goes down has been a strategy that has cost investors lots of money. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.